Can I run a little segue? I've already hit record, but can I run a little segue just because it's come up a few times? I think we've spoken about it plenty, Hamish, but for clients as well. So in the universe of sort of socially and ethically responsible investments, obviously we talk about future generations, and obviously a lot of our fee-for-service clients have got some exposure there. But I had a couple of queries over the last few weeks about what else exists in the universe of socially and ethically responsible investments, and how, if we're asking you to put forward some options for people about socially and ethically responsible investments, how do you, what's your sort of criteria in disseminating those? And again, what's your view in the social and ethically responsible investment universe at the moment?
Yeah, for sure. So I was actually at an investment conference a couple of weeks ago, and they had a couple of experts talking about this very topic. And the thing that kind of actually really surprised me was just this ESG definition is so broad. And the way that they actually explained it was that in theory, a fund manager that has an ESG focus could actually end up having a coal stock in there because of the way that they've simply said that they've thought about this process and what the future impacts will be, and they've sort of determined that balancing all of that in theory a coal stock could actually sit in there, which is sort of quite incredible.
Is this a little bit like, from a branding point of view, like calling something vegan and having all of a sudden it becomes the catch marketing cry, and that it just must be good because it says vegan? They've ticked the relevant criteria to be vegan, yet we're eating rubbish that's processed and no good, as an analogy.
Exactly right. So, and I think generally investors, when they, and this, the discussion sort of was about this, that I think investors generally, when they think about ESG, they think that it's kind of investing in some sort of green energy or, things that are actually doing good, but it could be something that's completely different. So there seems to be a really big disconnect between, what investors actually want or are looking for versus what's
this is a little bit more about the fine print of the investment itself, the investment fund itself. Just being able to elect what they don't put in rather than what they do put in. So we will exclude anything to do with cigarettes and gambling. So therefore we're ethically responsible. We've still got bucket loads of fossil fuel, coal mining and so on. So again, that's the difficulty, I'm sure, because there's the interpretation of what's ethically responsible is in the eye of the beholder. And if I'm writing up the report, I want to be an investment fund manager, well, I'll make it look pretty good. I'll just exclude 2 or 3 things that I wouldn't invest in anyway, and I can actually have that brand on my name, brand on the investment.
Correct me if I'm wrong here, Hamish, but there is no ethically or socially responsible regulator that says, well, this is the exact criteria that someone needs to meet. If you don't meet that, you can't brand yourself as that. Again, it's quite subjective, would you say?
That is exactly my understanding. That's right. So I think, though, to a couple of things, as Peter was sort of saying, I did see, I haven't looked at this in any great detail, but I did see some sort of a cynical tweet somewhere that looking at, was something like looking at sort of called the S&P 500 exchange traded fund, a very common broad-based exchange traded fund that might have had an underlying fee of less than 0.1%. And then you contrast that with some ethically focused fund, and it looked at the top 10 underlying positions, and they were exactly the same. One of them had, less than 0.1% fee, and the ethical one had 0.6% fee or something like that. So I think that's one thing to be aware of. Jay, to your question about how do I approach it for your clients, when I've had that specific question come through from clients, what I'll tend to do is look at, within Australia, there's a couple of ethically focused exchange traded funds, and you can actually see what the underlying positions are in those. So usually what I'll do is use that as the screen to say, right, well, these positions sort of sit within this ethically focused ETF. And then within that screen, we then sort of look to identify the businesses that we look to try and own for clients directly in other portfolios.
I think one of the things I've found with it was that every person's perception of what should be and shouldn't be in there is also different. So, you know, what one might actually deem as not being ethical, they think that's a great, you know, idea, and it's something that's going to be progressive. And I think, you know, looking at mining and some of the, you know, lithium producers and things like that is one area that is a really grey area where it gets classed as well. I think it was a while ago, Hamish, but we had a couple of clients and we basically give them, you know, a list of names which we think might fit, and let them start to funnel down and say, well, you know, these ones I'd like the idea of because of this, and these ones I don't want. And then we almost create our own internal filter of what they want, because it is very personal what they actually think is and isn't.
In the eye of the beholder.
Yeah.
So,
Those ETFs you mentioned, Hamish, do you know them off the top of your head, the name of those?
Yeah, so there's the beta shares. Let me just look this up. Beta shares. Beta shares ethical investing.
Yep.
And then there is another one that they have. There's an Australian sustainability leaders and a global sustainability leaders.
Yeah. Yeah, I think we've probably all said it in different ways that it is very it's a very subjective position for individuals, and also for any investor looking at what they deem as ethical and responsible, and whether they like you can drill so far down into the minutiae about not liking the CEO of a particular company because they seem to be unethical in their language almost. So you can go nearly any direction. So I suppose giving clients an opportunity, like you said, Hamish, to say, well, here's the sort of the benchmark. Here are the underlying holdings in this. Which of those, like you said, Ben, which of those fit your own individual criteria, and let people make that decision themselves almost.
Yeah, I mean, a classic example of conversation I had with a client last week about Facebook. So it obviously has a low carbon footprint, and maybe does some good things, but then there's also potentially a lot of issues with social media, and so does that sit? One person will have a completely different view to another.
Yeah, I think the approach from clients has been more so what they're interested in investing in, like the renewable energies and sustainable sort of investments in that respect, versus sort of more traditional, excluding, as we've already mentioned, gambling and that sort of thing. So I think clients probably tend to know more what they would like to invest in rather than perhaps what they necessarily wouldn't like to invest in.
Yeah. Short answer, to find that investment that is, investing in sort of renewables or something, it's difficult. It's really difficult.
And that also evolves to the companies that might at one point in time be very much into something that you would say is perfect, but then like some time back I found out that Woolworths, for example, had a fair bit of gambling involved in their ownings in their holdings in Queensland. That really surprised me. And then at the reverse of that, where some businesses will be very much fossil fuel, but in the background, they're doing a huge amount of work on solar and renewables. So they're ready for this transition. So You know, does that make them ethical or unethical? Because they're actually choosing to move on to a much better place as the future evolves. So
yeah,
it's really hard to interpret what's good and what's not. I think it does probably come back to our clients. Say, well, what is it you don't want to be in? What would you like to be in? And we'll try and find something that perhaps fits your particular ethical choice or your interpretation of ethical. Maybe.
And I think sort of bringing it back to your client portfolios. I mean, I'm just having a look here at the underlyings within this sustainability Australian ETF, and it's all, you know, it's things like ResMed and Xero and Goodman and Cochlear and Brambles and CSL and Telstra and Sonic Healthcare, Suncorp, you know, so it's not really a specific green thing. Then I think about if you take future generations, right, where, okay, the underlying fund managers may be investing in a BHP or whatever that is, but essentially there is 1% of assets being donated to charities. And so ultimately it's like, it's what is the, so take BHP, it might be investing in mines and whatever, but then on the other side of it, it might actually be investing in a lot of good to try and sort of improve the way that they're doing things. And I think with future generation, okay, there may be things within it that you may not like, but overall, the whole concept clearly does really good things. So.
An incredibly ethical concept. Yeah. If you want to define ethical, you know, again, I was having a conversation last night about the Royal Children's Hospital and, you know, a youngster that went through leukemia, treatment at the Royal Children's Hospital. And one of the things that was being talked about was the fact that Ronald McDonald, you know, McDonald's, the chain of McDonald's, you know, would you say they're ethical? Maybe, maybe not. You know, I don't particularly like going through Macca's and buying their junk, but they do an awesome job at the Royal Children's Hospital with the Ronald McDonald House, and a combination like Mikey and Maria downstairs at Three Little Figs spent 2 or 3 weeks in Ronald McDonald House while the little girl was in intensive care, the brand new baby. So that's pretty damn ethical. You know, so do you slam them because they maybe, you know, produce food the wrong way, or do you support them because they're doing this really good ethical thing as well? And so again, it's, you know, it's just swings and roundabouts, I suppose. Yeah, very, very, very subjective. Yeah. So it's a great concept, but it's a really difficult one to nail down to 1 or 2 particular things that fit perfectly. It's very interpretive. So, anyway.
Thanks, Hamish. We'll,
big topic.
Yeah, it is a good topic, and the ethical dilemma is real, not only in investing, but in sort of every circle. You know, we're presented with those sort of ethical dilemmas every day that we need to sort of sit back and assess and make our own personal judgments and how these things impact others as well. But let's talk about something else. Ben, PB, Delta, have you got any other?
I sent you an email before, Hamish, about, I think it was AMPOL. Only really quick look at that. Was there a buyback offer that they were floating? Is that right?
Yeah, that's right. So essentially, this is one of these off-market buybacks. So the way that it works is that an investor offers to sell their shares back to the company. They will sell their shares at a discount to the market price. So obviously that doesn't seem attractive on the face of it. But where it potentially becomes attractive for some investors is the majority of those proceeds are paid in the form of a fully franked dividend. And so for that individual that can use those franking credits, which would tend to be someone in a nil tax environment, that can then work out being very attractive.
Nice bonus on top of the share price.
Yeah, so that's exactly right. So the net result is, whilst you sell your shares back to the company at a discount to the market price, when you factor in the franking credits, you could actually, in fact, be selling your shares back to the company at quite a substantial premium to the market price.
There have been a handful of those over the last few years where our clients in pension phase, for example, or someone who's very much in a zero tax position, can end up, you know, making a 10 or 15% profit comfortably on that sale. And then if they wanted to, once they got the money, they could always buy back in, couldn't they? At the market price.
Yeah, Yeah. So there is obviously that risk that the market price of the shares ends up rising substantially, and therefore, there may not necessarily be the profit there, but it would generally appear to be a fairly solid risk reward.
For the
What's
right.
the sort of view on AMPOL broadly, I suppose, Hamish? It's been
So we continue to like it. It has a portfolio of assets that are incredibly difficult to replace. And I think that at the end of the day, the simplest way to think about this is the Canadian group was trying to take it over at sort of roughly $35, $36 a share at the beginning of the year before COVID. And then COVID happened, and so that deal fell off. The share price fell below $20 during COVID. It's now back to about $30 or a little bit over $30, $30.80. So ultimately, there is the feeling that that the group that was trying to take them over, could come back. But regardless, we just think it's a really solid portfolio of assets. And in addition to that, as you get that economic recovery, aviation fuel, people driving more, there is good leverage to that economic recovery also.
Just on the recovery of recent weeks, Hamish, is that it's been surprising to you or in line with your expectations? How have you viewed the pretty robust last month in the markets?
Yeah, look, I think it's, I can't say I expected the market to be as strong as what it has been.
You did say that once we got some vaccine certainty, the market would like that a lot, and true to form, that's exactly what happened. So
yeah,
you seem to be the oracle, Hamish.
I wish that was the case. Look, as I always say, no one can predict the short-term direction of the market, but we always have a stab at it. But the market has clearly gone up in anticipation of an economic recovery that would appear to now be happening. So that all makes sense. The one thing I think that we need to be somewhat conscious of is that the price of the market relative to earnings now is becoming quite extreme. That can be somewhat justified by these ultra low interest rates, together with the expectation that earnings growth will be strong over the next couple of years as we have the economic recovery. But the market has moved up a lot very quickly.
Hamish, with that, one of the things that we do is we don't actually buy the market. When the market broadly, the indices are clearly, way above where they've been, and they've been performing really well. But again, just sort of pumping up your tires a bit, the fact that we can actually break down the micro of the market down to a selection of 15, 20 or 30 shares that maybe still provide opportunities and, the advantage or the potential for good returns and reasonable growth, that, they may well be still a fair way short of where they could have been before the market crashed. So
exactly
picking the right
Peter.
ones, yeah.
And like a classic example, obviously, that everybody will have seen is Ramsay, that we've been buying. Pre-COVID, it was $80. Today, it's sort of $64, $65. So people, they have hospitals in Europe as well, but obviously, it was once thought that hospitals would be extremely defensive, but then, as it turns out, when you have a pandemic, people defer their elective surgery. But if that person's going to have a knee replacement and they've deferred it, ultimately they will still get that knee replacement. So, there would appear to be a huge amount of pent-up demand for a business like Ramsay. And the good thing about it is you don't necessarily need a strong underlying economy. So, we think it's a defensive business. It's very well run, and it's not expensive relative to where it's been.
Hamish, can you just quickly, the one you flicked through to me yesterday, the caravan park, the Australian business, I was interested in that, can you maybe, is it worth just perhaps touching on something like that? Because I was thinking about what's going to happen as we now unfold, and Shane Oliver last couple of weeks ago at a webinar I attended was talking about the big discrepancy between inflow of tourist money, which we're going to lose for a couple of years. We won't have internationals coming here and spending their holidays in Australia. But he said loosely 10 times as much money flows out with our travellers as comes in with tourists. And so we'll have 10, that money that normally would flow overseas with us travelling internationally will now be trapped in Australia for the next couple of years. So there's a huge opportunity for us Aussies to spend money here in Australia. And that flows on to what, that business you were mentioning to me by email. I think it's worth perhaps raising that as one of those possibilities, if you would.
Yeah, for sure. So I guess the first thing to say on it is certainly this could be held in SMSF portfolios. I'm not sure with North, so that would need to be considered. And the other thing is it's a smaller business, so it's only about $140 million market cap. But with that said, it's a business I know fairly well. It owns a portfolio of what they would call affordable accommodation. That is their target market. So what that primarily is comprised of is caravan parks that are either along the New South Wales coast, Adelaide, WA, and they've got one asset in Darwin as well. So that's sort of the core part of the portfolio. And then in addition to that, they also have a handful of other affordable accommodation assets. So an example of that would be they recently bought 2 blocks of apartments in Sydney, just near Chatswood, which is a sort of a key growth area. They paid an average of $200,000 per apartment. The average 1-bedroom apartment in that area sells for about, I think from memory, it was about $700,000. So it's extreme. The asset was originally sort of a retirement village structure, so they're restructuring that into regular rental properties, and essentially you're getting sort of almost a 2 times uplift on the valuation. So it's a great portfolio of affordable accommodation. The average capitalisation rate, or the average sort of underlying yield of the entire portfolio, is something like about 8.5%. And sort of the way that I think about it is, it makes sense to me owning a portfolio of property assets that are providing that affordable accommodation, because it's always going to need to be used. And then to be able to, rather than owning those assets myself, to have somebody else managing those assets on a daily basis makes sense to me. So the yield on APZ it's about 5% at the moment. There's no franking on that, but about a 5% yield, and I think that should continue to grow at reasonable rates going forward also.
Did you say APZ, Hamish?
That's right. A for Apple, P for Peter.
Yep. Z for Zorro.
Z for Zorro.
Z for Ziggy.
Yeah. Yeah, guys, we're going to have to wrap it up. We've covered a few bases here today, so thanks again, Hamish, as always. We're going to jump on to our team meeting now, but as always, thanks again, mate. Appreciate the update, and I know our clients do too. They tune in every fortnight to hear you, the Oracle of. Where are you based? Where's your hometown? What's your suburb called?
So the office is in Paddington, and I live in Bronte.
Okay, the Oracle of Bronte. So
Not
Bronte Oracle, Hamish Filletta. Thanks again, mate.
I'm blushing.
See
See you, everybody.
Hamish.
Have a great day. Take care.